The stock market is up celebrating the fact that another QE quantitative easing or easy money is just around the corner. Market expect Federal Reserve is going to start cutting rates in 2.5 months. President Trump is expected to nominate new Federal Reserve chairman that is going to replace Jerome Powell with someone that's going to do massive interest rate cuts. In this video, I will discuss why President Trump wants to replace Jerome Powell and the impact when Federal Reserve cut interest rates. The feud between Donald Trump and Jerome Powell, the current chair of the Federal Reserve, is a long-running and contentious one that largely stems from differing views on monetary policy and the independence of the central bank. The conflict began shortly after Trump appointed Powell as Fed chair in 2018. Trump's frustration escalated when the Fed, under Powell's leadership, began raising interest rates. Trump, who consistently advocated for lower interest rates to stimulate economic growth and boost markets, viewed these hikes as counterproductive to his agenda. Interest rates. This is the core of the disagreement. Trump has repeatedly and publicly criticized Powell for not cutting interest rates aggressively enough, arguing that higher rates hinder economic growth, increase government borrowing costs, and make the U.S. less competitive. Powell, on the other hand, maintains that the Fed's decisions are based on economic data, particularly inflation and employment, and that the central bank must act independently of political pressure to maintain price stability. The Fed significantly raised rates in 2020 to combat high inflation, a move Trump vehemently opposed. High interest rates will disrupt Trump tariff plan because high tariff will increase the price that imported from foreign country, which majority of our stuffs is imported from other country. With high prices, business is getting harder to borrow money, and higher prices means less sales and less revenue for business. Layoffs is increasing. People will get into much more difficult financial situation. All of this will make economy collapse and raising social tensions. High interest rates and Trump tariff plan cannot work together. With Trump policy plan, Fed interest rates must go down. But Federal Reserve has own idea that the chairman Jerome Powell vowed to make inflation rates down to 2%. Cutting Fed interest rates will raising inflation rates even more. Here are the impacts on an interest rate cut. Lower borrowing costs. Mortgage rates, car loan rates, credit card interest rates will likely decrease. This makes it cheaper for consumers to borrow money for large purchases, potentially boosting demand for housing, vehicles, and other goods. This will automatically raising prices. Companies will find it cheaper to borrow money for investments, expansion, hiring, and capital projects. This can stimulate business activity, leading to increased production and job creation, increased spending and investment. With lower borrowing costs, both consumers and businesses are more incentivized to spend and invest. This increased aggregate demand contributes to economic growth. Impact on savings. Individuals with savings accounts, money market accounts, and certificates of deposit will likely see lower returns on their deposits. This will make them to seek higher returns elsewhere, potentially in the stock market or other investments like gold and cryptocurrencies. Stock market reaction. Generally positive. Stock markets often react positively to interest rate cuts. Lower borrowing costs can boost corporate profits, and lower interest rates make equities more attractive relative to bonds. Sectors that rely heavily on credit, like real estate and consumer discretionary, may see particular boosts. Risk of asset bubbles. Prolonged periods of very low interest rates can sometimes contribute to asset bubbles as investors chase high returns, potentially leading to overvaluation. Investor will feel they are getting richer with all their stock appreciation. Bond market reaction. Bond prices rise, yields fall. There's an inverse relationship between bond prices and interest rates. When interest rates are cut, new bonds are issued with lower yields, making existing bonds more attractive. This drives up the price of existing bonds and causes bond yields to fall. With Trump tariffs war with all country, it will likely for foreign country or foreign institution will buy lesser U.S. Treasury, especially with lower yields and devaluing dollar purchasing power. Inflationary pressure. Potential for higher inflation. By making borrowing cheaper and stimulating demand, interest rate cuts can be inflationary. If the economy heats up too much, or if supply cannot keep pace with increased demand, prices for goods and services can rise. This is why the Fed carefully monitors inflation when considering rate cuts. Currency impact. Weaker dollar will cause lower interest rates, can make the U.S. dollar less attractive to foreign investors seeking higher returns. This can lead to a depreciation of the dollar against other currencies. A weaker dollar makes U.S. exports cheaper for foreign buyers and imports more expensive for U.S. consumers, potentially boosting exports and curbing imports. In summary, a Fed interest rate cut is a powerful tool designed to inject liquidity into the economy, encourage borrowing and spending, and stimulate growth. However, in the long run, the dollar getting weaker and our next generation will have to pay. Thank you for watching this video. If you find this useful, please like and subscribe and help us to grow this channel. Have a nice day.